So what is an inversion and why does it matter? Christina Leshy was just touching on this. In plain terms, during an inversion, investors get paid better to lend money for a shorter period of time than a longer one. That is not natural. That is not normal. In this case, if you lend, for example, for 2 years or 10 years, the rate of return is about 1.6%. For all the reasons we just mentioned, investors are nervous about the state of the economy. Throughout the year, they've been plowing into government bonds as a flight to safety because, unlike stocks, the returns are guaranteed. The more they buy, the lower the yield goes. Investors are now seeking safety in bonds, even though they're getting back a minute amount in terms of a rate return. The 30-year rate is now at a record low. Here is the larger concern and why it's causing a sell-off on the markets. The last 5 times there's been an inversion like this one, an average of 17 months later, there has been a recession. Bryson is the managing director and acting chief economist for Wells Fargo Securities. He joins us live now in Charlotte, North Carolina. So, Jay, thank you so much for being with us. So, overall, are fears of a recession right now justified?
Well, you know, the only thing that you're looking at that's a potential recession signal right now is that slight inversion of the yield curve that you just mentioned. I mean, other than that, when you look at the underlying fundamentals of the U.S. economy today, they remain generally pretty strong. You look at balance sheets of households, balance sheets of businesses, of the financial sector, they're all in reasonably good shape. And so, you know, again, this is the only sort of signal that we're getting right now that would say maybe trouble is ahead.
And also, yes, obviously an inverted yield curve might be a reliable indicator of a recession, but it doesn't always precede a recession, does it?
Well, it's had a pretty good track record in the last few decades, right? But what I would point out here is, and I don't want to be one of those economists who say, well, this time it's different, okay? But there is a little bit of difference, and that is, and you had just mentioned this, when people buy more bonds, it causes your yield to go down. Well, a big buyer of bonds over the last decade was the Federal Reserve. It was part of this quantitative easing sort of program, and it was intended to bring yields down. And so the question is, if the Fed hadn't done this quantitative easing, and keep in mind, there's still $2 trillion worth of government bonds on their books, how much higher would those long-term yields be right now? Would the yield curve, in fact, be inverted or not? And that's a very good question. And as I said earlier, it's really the only signal that we're getting right now that maybe there's some trouble ahead.
You bring up a good point that the Fed obviously plays a role in all of this, but just walk us through how long the yield curve has to stay inverted for it to really signal a recession, do you think?
Yeah, it's usually typically a number of months before you get that. And this morning, the 10-year was about 1 basis point lower than the 2-year. Just the last time I checked, it had flipped back the other way. So it's, you know, essentially flat right now. And generally, you want to see it more like, you know, -20, -30, or even 40 basis points before it really become a reliable sort of signal. So it's something very interesting to keep an eye on at this point. It's an interesting telltale of what the market is thinking. But at this point, just because we inverted today only slightly, I wouldn't say it's necessarily foolproof either.
And do you think the Fed should be cutting interest rates more aggressively, given the warning signals we're seeing?
Well, I do believe that the Fed should definitely be cutting at this point. And, you know, whether or not more aggressively, I mean, do they need to cut 50 basis points at the next meeting? I mean, we'll see. There's still a number of weeks between that here and the next meeting. The only reason I believe that the Fed should probably be cutting at this point is there's just no inflation in the economy. And so if you have an economy that potentially could be facing some difficulty going forward without any inflation, then what's the risk right now of cutting? There isn't much of a risk. They can always reverse it later on if they need to be. So,
it's not permanent.
you know, so the Fed clearly will be cutting rates.